Welcome to our second quarter video update for the year 2024. I am joined today by my colleagues Janet Kinsing, and I would like to welcome back Paul Carter, Senior Portfolio Manager at Capstone Asset Management. Welcome, everyone.
Hi, Maria. Hi, Janet.
Hi, Paul. Welcome back. You've quickly become a regular here, and we're pleased to hear your thoughts once again. I know you have a lot to say today, so let's jump right into our questions. We're now over halfway through 2024, and we're wondering, where can investors see opportunities to invest their funds in the market? How can CSIS play a part in capitalizing in some of these opportunities?
Yeah, so 2024 has actually been a really good year for equity investors in particular. Looking at year-to-date returns to July 19th in Canadian dollar terms, the broad Canadian stock market is up 10%, international stocks are up 12%, and the US stock market is up a whopping 21%. The theme that dominated equity markets last year has continued into this year, in that it's really been the large cap growth stocks in the US that have propelled returns during this bull market. For instance, the Magnificent Seven, as the saying goes, so that would be Apple, Amazon, Microsoft, NVIDIA, Google, Tesla, and Meta platforms, are up 36% on average this year. By comparison, the S&P 500 equal weighted index is up only 8%. This is a continuation of the trend that we saw last year when the Magnificent Seven crushed all other parts of the market by climbing 107% on average. Now, despite these eye-watering returns on a go-forward basis, it is important to be clear-eyed about what's going on around us. There's no denying that it is a turbulent time in both the economy and the world today. Recently, we've seen the attempted assassination of former US President Donald Trump, current President Joe Biden stepping down from seeking a second term, the ongoing wars in Gaza and in the Ukraine, etc. On top of geopolitical concerns, economic growth rates remain sluggish in many parts of the world, including here in Canada. And inflation, while coming down, is still proving to be a bit stickier than what everyone had hoped for at the beginning of the year. The good thing with the investment markets is that no matter what is happening in the world, there are always opportunities to invest and to position yourself to achieve good or at least acceptable risk-adjusted returns over the mid to long term. Even in the US stock market, which we would describe as expensive currently, there are lots of value opportunities outside of the Magnificent Seven, especially among smaller companies. For instance, one of the investment managers that we use in the Capstone traditional equity pool has had a number of its smaller cap holdings in the industrials, technology, and healthcare sectors increase 20 to 50% over the last few months. One of those companies is smart home security company Arlo Technologies, which manufactures wireless surveillance cameras. Arlo saw its stock price soar 75% so far this year, as it posted record service revenue and growth in free cash flow as demand for its safeguarding solutions is growing. And we're particularly constructive on Canadian stocks right now. CSIS, which stands for the Capstone Canadian Equity Income Strategy, isn't typically subject to the same kind of explosive stock price growth. However, its mandate is to generate returns from a combination of regular cash dividends and stock price appreciation, and we see lots of good values in the market today. CSIS portfolios are currently yielding about 4.6% from dividends, and we think that there are many opportunities to achieve capital gains on top of that. The companies within CSIS may not be growing like an Arlo Technologies, but they are all very fairly priced or cheaply priced, in our opinion. One example would be Exchange Income Corp, which is based in Winnipeg. They're currently trading at about 11 times next year's earnings and pays a monthly dividend yielding about 5.5%. And that's a dividend that's grown at a rate of about 5% per year over the last decade. Exchange Income owns a number of companies in both the manufacturing and aerospace and aviation sectors, and is currently experiencing excellent growth in revenue and important contract wins in a number of them. Open Text in Waterloo, Highliner Foods in Lunenburg, Nova Scotia, and Cogeco Communications in Montreal are other companies that are also trading at less than 12 times earnings, where we think significant stock price appreciation could occur in the coming quarters.
Thank you, Paul. Let's move on to fixed income. The Canadian Universe Bond Index is up over 3% through the last 12 months, but only slightly positive year to date. What do you think we can expect for the rest of 2024?
Yeah, so different parts of the fixed income market have experienced some fairly different returns over the last 6 to 12 months. If you're talking private credit, that asset class has actually done fairly well. For instance, the Morningstar LSTA US Leveraged Loan Index is up just shy of 5% so far this year. Private credit returns are typically correlated with short-term interest rates. So with the overnight lending rate in Canada at 4.75% and the US federal funds rate at 5.25% to 5.5%, private credit returns have been fairly solid. Traditional bonds, though, are a very different story. Traditional bond investors have had a very difficult time generating positive returns the last few years, especially on an inflation-adjusted basis, as the normalization of interest rates from the ultra-low pandemic levels wreaked havoc on the market value of fixed-rate government and corporate bonds. In Canada, the FTSE Canada Universe Bond Index returned about -3% in 2021 and -12% in 2022. And then through the first 9 months of last year, the index was down another 1.5%. Last fall, though, as investors started to look ahead to 2024 and concluded that the US Federal Reserve and Bank of Canada were both going to cut interest rates significantly, interest rates across the yield curve fell and bond returns exploded upwards. The bond index was up over 8% in the fourth quarter, its best quarter in almost 40 years. Unfortunately for traditional bond investors, the stickiness of inflation resulted in those expected policy rate cuts to be pushed out several months. This caused the yield curve to shift up again. And so far this year, to July 19th, the bond index is up only about 0.4%. Now, going forward, we are fairly optimistic about the opportunities in the traditional bond markets, although we are not expecting another 8% quarterly return anytime soon. Currently, the weighted average yield to maturity of the Canadian bond market is about 4.1%. While that's not amazing, it is a huge increase from what it was just a few years ago when it was hovering around 1%. So assuming no material corporate defaults, you could just hold the average bond until maturity and earn, about 4, maybe just over 4%. However, despite the widely anticipated 2024 interest rate cuts being pushed into the future somewhat, the Bank of Canada did finally cut its policy rate by 0.25% last month and will likely do so again later this week. Now, this, combined with a slight decrease in the yield curve, should result in mid-single-digit returns for bonds, generally speaking, between now and the end of this year. Private credit, on the other hand, could do a little bit better than that, but probably not by too much.
Thanks, Paul. So inflation is a topic that is always top of mind and one that certainly impacted all of us over the last couple of years. What have we seen so far in 2024, and what are your expectations for the rest of the year?
Yeah, so last week, actually, Statistics Canada reported that the Canadian Consumer Price Index rose at an annual rate of 2.7% in June. This is down quite a bit from the 3.9% inflation rate that we saw last year, and is generally consistent with the trend towards the 2% level that the Bank of Canada ultimately wants to see. Importantly, this latest report increased investor confidence that the Bank of Canada would continue on its interest rate easing cycle that it began in June. The average Canadian bank economist now expects inflation to decline from about 4% last year to 2.5% this year, and then down to 2.2% next year, and then to stay at that level. Now, if that happens, I think that would be great news for both borrowers and investment markets, as shorter-term interest rates would undoubtedly fall and longer-term interest rates would remain fairly stable. However, I'm not so sure that we should be declaring victory on inflation just yet. I have a feeling that inflation is going to be a bit stickier than what a lot of people expect for a few reasons. First, gas prices. While the price at the pump in Canada has ticked down a little bit over the past couple of months, gas prices are still higher on average this year than they were last year. And if the Israel-Gaza conflict expands into a wider regional war, like many people are worried about, we could definitely see $90 or even $100 oil once again, which would translate to further energy price hikes. As well, shelter inflation in this country continues to be terrible. Rents jumped by 8.8% year over year in June due to the long-standing housing shortages across the country, shortages which will not be solved anytime soon. In addition, irresponsible and out-of-control spending by the federal government is nothing but inflationary. Over the last 12 months, government spending in Canada was up 7% year over year, after being up by more than 30% relative to the last year pre-COVID. And we're up across all major categories of spending. And then in April, Finance Minister Chrystia Freeland unveiled the latest federal budget, which calls for $53 billion in new spending over the next 5 years, a significant jump over what Ottawa had said it would spend in last year's fall economic statement. So that's definitely not disinflationary. But the biggest issue might be what's happened with inflation expectations. The latest the Canadian Survey of Consumer Expectations, which is a quarterly survey that the Bank of Canada conducts, shows that Canadian consumers currently expect inflation to be up by more than 4.1% over the next year and 3.9% over the next 2 years. This is much higher than normal and is bad news in that we are all becoming somewhat numb to inflation and are now starting to expect high inflation to continue. Now, this is a big deal because if we are all expecting inflation to continue at high levels, that will make it easier for businesses to pass additional price increases through to consumers. As well, we will all push for higher wages, which will contribute to the ongoing wage price spiral. Currently, private sector workers expect wage growth of close to 3%, which is very high by historical standards. And wage growth expectations among public sector workers have climbed for 6 straight quarters and are now the highest they've been since well before the pandemic. The longer we go thinking that 1% to 2% inflation is a thing of the past, the harder it will be to put the inflation genie back in the bottle. So anyway, that's my long-winded way of saying that I expect inflation this year and next to be a little greater than what economists are expecting, and why I hope the Bank of Canada isn't too eager to cut interest rates aggressively, thinking that the inflation problem is firmly in the rearview mirror.
Thanks, Paul. So switching gears a little here, recently you were in Rwanda viewing the progress of the Kinvest farm. What updates can you share with us regarding the Capstone Kinvest Impact Fund, and what can potential investors expect from this fund?
Yeah, so I was able to spend a week in Rwanda back in December and got to spend time at the 3 different farms that the Capstone Kinvest Impact Fund has invested in the eastern part of the country in the beautiful Nyagatare district. We're really excited about not just the business of Kinvest Farms, but also about the impact that our investors are going to have on the rural communities there. Just as background, the Capstone Kinvest Impact Fund is a US dollar denominated limited partnership and is structured as a private equity vehicle. What that means is that it's not a continuous offering like a mutual fund where investors can buy units of the fund anytime they want. Rather, we have specific closing dates over the course of a 1-year period. Our first closing was last fall. We had a second closing in February, and then a third closing here in July. To date, we've raised close to $5 million US and hope to raise up to another several $1,000,000 in our final closing at the end of September. So far, the money that we've raised has gone toward the acquisition of 3 different farms, Impano, Cabiro, and Tuagiri, and then various capital expenditures to build out these farms. The big step we're working on currently is irrigation. We are in the process of having the customized state-of-the-art drip irrigation systems for these farms designed and manufactured by an Israeli company called Netafim, which is the global leader in irrigation solutions. Once those are manufactured, they will be shipped to Rwanda and installed in the fields. Beyond that, Kinvest is building roads, bridges, staff housing, and making the other capital investments necessary to develop these farms into commercial businesses. Road and bridge construction has been an important part for the team in Rwanda recently, as these will improve market access as the farm's first crops are harvested. In terms of expectations, our goal for the fund continues to have a good balance between offering investors a solid financial return over the long run and having a positive impact on the ground in Rwanda by training local entrepreneurs to develop and cultivate farmland, grow and harvest crops, and distribute crops globally, and through ultimately transferring majority ownership of the business to the workers upon the wind-up of the fund. How big the farm operations will grow will be dependent upon how much money we ultimately raise, but hopefully additional investor interest will allow us to expand beyond the 3 farms we have currently.
Yes, that would be really exciting to see. So Paul, one last question for you. Do you have any thoughts to share about the upcoming US election and how this might affect the US equity markets?
Yeah, great question, Janet. So 2 days ago, President Biden dropped his bid for re-election. And then yesterday, we learned that Kamala Harris will definitely be the Democratic presidential nominee. So we are in the very early days of it all. And there is so much that needs to still unfold. But perhaps that's actually a good question to revisit at our next quarterly review, as I think we'll have a much better idea of how a Trump presidency or a Harris presidency could impact the different investment markets.
Okay, Paul, thank you so much for joining us today, and we look forward to having you back with us again soon. And to our viewers, we hope you've enjoyed this quarterly update, and please stay tuned for next month's edition of Your Wealth Matters. So until next time, bye-bye.
Bye.